While you were sleeping this weekend, the war changed. Not incrementally, fundamentally. Donald Trump posted at 2 in the morning. Saturday, today, Iran will be hit very hard. He then told reporters that the United States is expanding its target list to new areas and groups of people, language that multiple defense analysts have interpreted as a signal that the campaign is shifting from military targets to regime infrastructure. Israel launched new strikes on Beirut, killing IRGC Quds Force commanders in a hotel in a tourist district. The war just jumped from Iran to Lebanon. Kuwaiti airports were hit by drones. Saudi Aramco's Ras Tanura refinery, one of the largest oil processing facilities on Earth, has been struck. And in Tehran, the bombing of fuel storage depots has created fires so toxic that Iran's Environmental Protection Agency issued an acid rain warning, telling 20 million residents to stay indoors. 6 American soldiers came home in flag-draped coffins on Saturday, the first combat deaths of this war. Donald Trump attended the dignified transfer at Dover Air Force Base. This is no longer a limited strike. This is an escalating war with American casualties, spreading across multiple countries, with no ceasefire in sight. And here is what matters for every person watching this who owns silver, is thinking about buying silver, or is trying to understand what happens next. Tomorrow morning, Monday, March 9th, is the first trading day since all of this happened. Markets have been closed for 2 days while the war expanded dramatically. And it's not just the war. Tomorrow is also the first trading day under the new 14% margins. The CME cut silver margins from 18 to 14%, effective after Friday's close. That means every trader coming into Monday's session has 22% more buying power than they had on Friday. So let me tell you exactly what is about to collide tomorrow morning at 9:30 Eastern Time. A dramatically escalated war, freshly reduced margins, oil above $90, a collapsing labor market, rate cuts being priced in, COMEX at 20-year inventory lows, and a silver price sitting at $85, 30% below its all-time high. Everything that was true on Friday got worse over the weekend. And the tool that was suppressing the price got weaker. That is the setup for Monday. And in this video, I'm going to walk you through exactly what happened, what it means, and why the next 5 trading days could determine whether silver stays in the 80s or breaks back above 100. Let me give you the full picture of what changed this weekend, because the scale of the escalation is being dramatically underreported. The war entered its second week on Saturday, and the tone from the White House shifted from limited military operation to something much more aggressive. Trump's social media post said Iran will be hit very hard and that attacks will continue until they surrender, or more likely, completely collapse. That last phrase, completely collapse, is regime change language. Bloomberg reported that the U.S. is considering striking areas and groups in Iran that were not previously considered targets. The Washington Post confirmed that Trump told advisors he wants to expand operations. On the ground, the results are devastating. Iran's Red Crescent reports over 6,600 civilian structures damaged by U.S.-Israeli strikes. The World Health Organization has identified 13 Iranian health facilities hit during the fighting. Over 1,300 Iranians have been killed, according to the Red Crescent, and the war is spreading beyond Iran's borders. Israel struck a hotel in central Beirut, killing 4 people, targeting IRGC commanders. Drones hit fuel storage at Kuwait International Airport. Saudi Arabia's Ras Tanura refinery was attacked. The U.S. Embassy in Riyadh was hit by suspected Iranian drones. Amazon confirmed that 3 of its data centers, 2 in the UAE and 1 in Bahrain, were struck by drones affecting operations. China's foreign minister, Wang Yi, called for an immediate ceasefire, warning that the flames of war risk spreading. This is significant because China is preparing to host Trump in Beijing. When China publicly warns about a war involving the United States, the geopolitical temperature is approaching a level that markets cannot ignore. If you own silver and you want to understand what Monday means for your position, subscribe and hit the bell, because what I'm about to show you is how all of this connects to a price move that could begin in less than 16 hours. Now, here is why the specific weekend escalation matters more than any development in the previous 7 days of the war. When the war started on February 28th, markets initially responded with a safe haven surge. Silver spiked from 87 to 96 in a single session. Then the CME margin weapon kicked in, the dollar strengthened, and silver was pushed back to 82. The initial war premium got crushed by paper market mechanics. But what happened this weekend changes the calculus. The war is no longer a shock event that markets can price in and move past. It is an escalating conflict that is getting worse, spreading to more countries, producing American casualties, and showing no signs of resolution. Trump explicitly said it will continue until Iran completely collapses. That is an open-ended commitment to military action with no defined endpoint. For oil, this means sustained supply disruption. Brent crude is above $90. The Strait of Hormuz remains effectively closed. 150-plus tankers are still stalled. 20% of global oil supply is still disrupted. And now Trump is talking about escorting tankers with Navy vessels, which means he expects the disruption to continue long enough to require military escorts. For the dollar, this means more war spending. The Center for Strategic and International Studies estimated the first 100 hours of the war cost $3.7 billion, $891 million per day. None of it budgeted. All of it added to the $38 trillion national debt. Every day this war continues is another day of unplanned government spending that devalues the currency. And for silver sits at the intersection of every one of these forces. It is a safe haven asset that benefits from geopolitical chaos. It is priced in dollars that are being debased by war spending. It is an industrial metal used in the missiles being fired, and its physical supply chain through Dubai and Hormuz is disrupted by the same conflict that is driving demand. Now let me show you why Monday specifically is the day this could break. Markets have been closed for 48 hours. During those 48 hours, the war expanded dramatically. Trump escalated his rhetoric. American soldiers died. New countries were attacked. Acid rain is falling on Tehran. China called for a ceasefire, and oil continued to surge. All of this demand, all of this fear, all of this capital-seeking safety has been building up behind a closed door for 2 days. When that door opens at 9:30 Eastern Time tomorrow, the accumulated pressure hits the market all at once. This is a well-documented phenomenon in commodity markets. Weekend risk events that happen while markets are closed create gap opens, price jumps that occur between Friday's close and Monday's open. After the first weekend of the war, February 28th to March 2nd, silver gapped up from 87 to 94 in the first hour of trading. An 8% move before most traders had finished their coffee. This weekend's developments are arguably more significant than the first weekend. The first weekend was the shock of war starting. This weekend is the realization that the war is escalating with no end in sight. The shock premium gets priced once. The escalation premium compounds every week the war continues. And here's the mechanical factor that makes this Monday different from last Monday. Last Monday, margins were at 18%, the highest they'd been in the entire rally. Traders needed roughly $75,000 per contract to hold a silver position. Monday morning, margins are at 14%. That's $59,000 per contract, $16,000 less. For a fund managing 100 contracts, that's $1.6 million of freed up capital. For the entire market, it's billions. Lower margins, plus a weekend escalation, is the exact combination that produced the biggest moves in silver's recent history. On January 20th, Trump's inauguration weekend was followed by a Monday where silver surged to $100 for the first time. On February 28th, the war weekend was followed by silver spiking from 87 to 96. The pattern is clear. Weekend catalysts plus Monday open equals volatility. And this time, the catalyst is bigger and the margins are lower. Now layer the macro picture. Friday's non-farm payrolls showed the economy lost 92,000 jobs. The interest rate swap market is pricing 100 basis points of cuts. The Fed is trapped between fighting inflation from oil and supporting an economy that's contracting. Every data point is pushing toward easier monetary policy, which historically pushes silver higher. Oil above $90 is the accelerant that most people are underestimating. High oil prices feed directly into inflation expectations. Inflation expectations push real interest rates lower, even if nominal rates stay flat. And negative real rates are the single strongest historical predictor of precious metals rallies. In the 1970s, when oil shocks drove negative real rates, silver went from $150 to $50. We are entering the same macroeconomic structure today. Oil shock, negative real rates, fiscal deficits, and a central bank that cannot tighten without breaking the economy. Let me tell you what the smart money is doing right now, because their positioning tells you more than any analyst's prediction. COMEX delivery data shows that institutions stood for 52 million ounces in the first week of March alone. That is an extraordinary number against 86 million ounces of registered inventory. They are not rolling forward, they are demanding physical metal, and they are doing it during a war that has disrupted the primary logistics routes for moving that metal. JP Morgan took delivery of 99% of all January COMEX notices. February set an all-time record. March is on pace to exceed February. The pattern is unmistakable. Institutional players are converting paper claims into physical metal at an accelerating rate. They are preparing for a market where paper prices and physical prices diverge permanently. And this weekend's escalation makes that divergence more likely. If the war continues to spread, if Dubai's airport remains closed, if the Strait of Hormuz stays blocked, if shipping insurance rates keep climbing, the cost of physically moving silver from where it is stored to where it is needed will continue to rise. That creates a physical premium above the COMEX spot price. Shanghai is already trading $10 to $15 above COMEX. India's premiums flipped from a $50 discount to parity in 48 hours when the war started. If the conflict escalates further this week, physical premiums could blow out to levels that make the paper price meaningless. Here's the question I need this community to answer. And I mean it, because your responses have been more valuable than any research note I've read this month. If silver opens at 85 on Monday, where do you think it closes on Friday? Drop your number in the comments. Give me your reasoning. Because this is the most important trading week for silver since the January crash, and the collective intelligence of this audience is one of the most undervalued assets on YouTube. Now let me give you the scenario analysis. Scenario 1, limited escalation. The war continues but doesn't expand further. Oil stays around 90. Silver retests 90 to 95 on safe haven demand and lower margins. This is the base case. Probability, about 40%. Scenario 2, significant escalation. Trump expands targets, as promised. Iran retaliates against more Gulf infrastructure. Oil pushes above 100. Silver breaks above 95 and approaches the psychologically critical $100 level. The lower margins allow traders to hold through volatility instead of being shaken out. Probability, about 35%. Scenario 3, ceasefire or de-escalation. Iran's president already apologized to neighboring states. If back-channel talks produce a ceasefire, oil pulls back, and safe haven demand drops. Silver could test 80 or 78 in the short term, but the structural deficit, the margin cut, and the rate cycle remain bullish regardless. Probability, about 25%. 2 of 3 scenarios, representing 75% probability, point to silver at or above 90 by Friday. And in the significant escalation scenario, $100 is not just possible, it's the most likely outcome. In the last 10 days, silver has been trapped between $82 and $86. This is what technical analysts call a consolidation range. The price is coiling, like a spring being compressed. It's building energy for a move. The question is which direction. Everything that happened this weekend points up. The war escalated, the margins dropped, the labor market collapsed, rate cuts are coming, oil is surging, COMEX is draining, and the price is sitting 30% below its all-time high, while every major bank has targets 2 to 4 times current levels. But I want to be honest about what could go wrong on Monday specifically. Gap opens can go in both directions. If ceasefire rumors surface overnight, silver could gap down. If the dollar spikes on a risk-off move, where traders sell everything and rush to cash, silver could get caught in the crossfire temporarily. And the CME still has the ability to raise margins again if volatility exceeds their comfort level. Here is what's in your control. Not the war, not the gap, not the CME. What's in your control is understanding the structure of what is about to hit the market tomorrow morning. A war that just escalated dramatically. 48 hours of accumulated demand, the lowest margin requirements since the rally began. An economy in contraction. Rate cuts being priced. Oil above 90. Inventories at 20-year lows. And a price that has been artificially suppressed for 30% below where the physical market says it should be. January 20th, the inauguration Monday, silver broke 100 for the first time. March 2nd, the first war Monday, silver surged from 87 to 96. Tomorrow is the third Monday catalyst. And this time, the margins are lower, the war is worse, the economy is weaker, and the physical supply is tighter. I've been covering this market every single day since December. I've shown you every margin hike, every crash, every recovery, every delivery report. And I have never seen a setup where this many catalysts converge on a single trading day. Monday, March 9th, 2026. 14% margins, an escalating war, a contracting economy, and a silver price that every major bank on earth says is dramatically undervalued. Whatever happens tomorrow, whether silver opens at 88 or 92 or 83, remember the structure. The paper price is temporary. The physical deficit is permanent. The war is escalating. The margins have been cut. And the spring that's been compressed for 30 days is about to release. Set your alarm. Be awake for the open. Because the first hour of Monday's session will tell you whether this week is the one where silver reclaims triple digits, or whether the machine finds one more way to delay the inevitable. Either way, you'll know within 60 minutes, and you'll know because you understood the setup before it happened, not after. Monday is loading. The market opens in hours, and $85 is about to meet the most explosive combination of forces this market has seen since January.